Hi, everyone. This is Jason Burack. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a managing partner at Stanphyl Capital, hedge fund manager, Mark Spiegel. Thank you for joining me again.
Thank you for having me as your guest. I'm honored.
So, Mark, the last couple of weeks have been really interesting. We've had, I would call it a remarkable rally in really bad fundamental tech stocks. Would you call this one of the largest short squeezes you've seen in a long time?
Well, I don't know how much of it is a short squeeze. I mean, I've seen some data, and how much of it is just, people underinvested or, feeling they were underinvested, feeling they were too bearish or whatever. So I'm sure it's a combination of both. And look, it's been really nasty. I mean, it's been nasty for me, for my fund, because our largest individual short position, of course, has been Tesla, and Tesla's up like 100% off of its lows, or it was at one point earlier today. So that's been bad. We're also short a ton of SPY, a lot more than Tesla, and that's also bad, but not as bad. So yeah, it's bad. But if you look at like a long-term chart of the markets during other bear markets, I mean, after the 2000 crash, NASDAQ had rallies of like 40, 50% on the way down. This one wasn't anywhere near that much. So, any bear market rally is bad if you know where things are going eventually, or you think and you're positioned for it. Let me put it that way,
And how many times did the NASDAQ rally after the tech bubble burst? So was it just once where there was one big short squeeze, short covering rally of 40, 50%, or were there multiple in, say, 6, 12, 18-month span?
No, there were many of them. I think, I think there was like a 30% or a 40% or maybe a 50%. I mean, at increasingly lower levels. So, but you can, if you pull up a long-term chart, you can see it. Just pull up the NASDAQ or even QQQ. Pull up a weekly chart from that era, and you'll see what I'm talking about. So it's not at all unusual. Let me put it that way. And by the way, again, some of it's a short squeeze rally. Some of it is just people sold everything and thought, oh, this is it. The bull market's back. So then they get back in, at exactly the wrong time. It's not always just short covering.
And for our listeners out there, we're recording this interview on Thursday, February 16th, 2023. Do you think that the corporate insiders, so these senior executives at these bad fundamental tech companies, are they going to take the opportunity then to offload a lot of their shares into this rally?
Well, I think they have been. I mean, if you see charts of insider buying versus selling, there's been a pretty large amount of insider selling. Although it's been a little bit hard, right? Because this rally really happened in January and the first 2 weeks of February. So, for most companies, January is a quiet period because you're about to report your year-end earnings. So a lot of them probably didn't have a chance to dump stock until after they reported, which maybe would have been for some of them, last week or this week. I think it'll be a more interesting test to see what happens, the second half of this month and into March, because then they'll be past any kind of windows. Or I shouldn't say windows, past any kind of, restrictions.
Yeah, and you also have people that are rebuying, I guess, after harvesting tax loss selling. So that's also probably part of the reason there was some type of rally.
Well, that's possible. Although it's possible. I mean, look, this rally really started, like the third or fourth day of January, something like that. So I guess it depends when people did their tax loss selling. I mean, if you did it at the end of December, it wasn't 30 days yet, So that could be some of it. I mean, look, these things just happen. I mean, if everyone gets too far to one side of the boat, most of the time, the boat's going to go back the other way a little bit, And if you look at my favorite sentiment indicator is CNN's fear and greed indicator, which is updated all day long. It's got, I think, like 7 different parameters, and it's a pretty good sentiment indicator. And it actually started tagging extreme greed I think last week and earlier this week, and now it's well into greed. And the AAII poll, American Association of Individual Investors, that actually flipped bullish for the first time in like well over a year last week. This week it was a little bit less so, but still net bulls, I believe. And so those are good. If they're not perfect timing indicators, but they're pretty decent sort of contrary indicators to tell you how people are positioned.
So have we seen a lot of share dilution or equity yet? Because if I was running one of these, if I was a senior executive running one of these bad fundamental tech companies and I didn't have a lot of cash on the balance sheet, didn't have profit margins and free cash flow, and all of a sudden my shares had rallied 100%, 200% as what's happened recently, I would be thinking, my gosh, I need to be on the phone, emails all the time with investment bankers, pension funds. I need to go raise some capital. So are we going to see that in the near future, or has that already started yet?
Well, first of all, you say bad tech companies. I assume you sort of mean shitcos, not like legitimate tech companies. I mean, there's a lot of shitcos that might call themselves tech companies when they're really not. They're just, stock promotions or whatever. Yeah, I guess. But the thing is, you've got to report first. You've got to report your year end and get out your 10K before you can raise money. And some of the smaller ones that need the money the most haven't done that yet. They tend to report towards the end of the allowable window to do it. So, we'll see what happens. I mean, I guess Bed Bath & Beyond did that really nasty kind of offering, but I don't know. I mean, I don't really track. Basically, what you're talking about is, excuse me, what you're talking about is like let's call it the Cathie Wood ARK portfolio, right? With a couple of exceptions. And so I don't really track those companies individually. I mean, we were short ARK almost from the top in early 21. I got short a lot of ARK, and it was a home run for us. And I covered way too early. I mean, I covered it down like 50%. I think I shorted it, I don't know, in the 140s, 150, something like that, and covered it like in the 70s. And of course, it got down to what? I think 29 and change. So, I covered that way too early, but it was still good for us. But so I've kind of lost interest in tracking that, her portfolio, other than, of course, we're short a lot of Tesla, and that's her largest holding, on and off largest holding.
Yeah, we'll talk about Tesla in a couple of minutes, but from your experience, though, when these companies actually do enormous share dilutions, that tends to kill the rallies in the stock, right?
Well, they say that, look, any bubble is looking for a pin, right? It's looking for something to pop it. And they say that the pin that popped the 2000 bubble was supply. I mean, things got crazy, and there was just a deluge of, new IPOs from crappy companies and follow-on offerings from crappy companies, secondary, and so, that's what popped it. We haven't seen, I don't think, so much of that during this rally. But again, as I said, it's a funny time because it's from what I remember from my investment banking days, it's very difficult to do a stock offering if the quarter has closed and you haven't yet reported that quarter, right? And in this case, it would be the full year report. So for most companies, I think we would have seen a lot more if this rally hadn't happened in January. Let me put it that way. I mean, if this rally had happened in February and the first half of March, we'd probably see a lot more offerings than we've seen.
So I want to ask you now about Tesla Motors and electric vehicle companies, because like you said, they've just had an enormous rally lately. Do you think a lot of this is because of Congress? It looks like, again, Congress is changing the rules, trying to help out the electric vehicle companies when they get in financial
No. There is zero fundamental underpinning to what Tesla just did. The entire thing was call option gamma driven. I mean, people spending hundreds of millions of dollars on calls struck $10 higher, that expire the next day, or in 2 days or whatever. I mean, that was the entire thing. It was all options gamesmanship. The Tesla fourth quarter earnings report was pretty bad, and the January price cuts they announced, which at that point was an average of about 12% per car, which basically slices the profit roughly in half per car, was an absolute disaster. It guarantees that this year the company earns at least 25% less than it did last year, and maybe worse than that, maybe 30% less, maybe 35% less. It is no longer a growth company. It is a commodity auto producer slashing prices and profits to sell a few more units. And like, it was basically, the day after they announced those really deadly price cuts, deadly to profits, that the call option gamma started, and the stock just took off and flew and never looked back really until maybe today. I mean, today it was down a lot. And so it seems to happen at the worst time that this stuff comes in. It's like there's some kind of syndicate of people who support this stock in a highly leveraged way, which is, via those call options. I could make some guesses as to the handful of people who have deep enough pockets to do that, who would be incentivized to do that. But seeing as I can't prove anything, I won't say who I think is behind it. Okay, but you can make some guesses on your own.
Well,
but in fairness too, it wasn't Tesla in isolation. I mean, there were a lot of shitty companies that made those kind of crazy moves this month. But I mean, nothing made a move like Tesla. I mean, basically, more than $100 move off the lows, and there's like 3.2 billion shares outstanding. It basically ran up 330 or 340 billion dollars on really bad fundamental news, undeniably bad fundamental news. So, that's just insane. I mean, look, I know people, names that who have been around a long time, who tell me they've never seen anything like the action that's happened, over time with Tesla, and particularly in the last 6 weeks with Tesla. I mean, it's unheard of for a company to go up by $320 billion on really bad guidance and huge margin declines.
Yeah, I see the mainstream financial media spinning it as these electric vehicle tax credits, but you said why, and they're not talking. I've never seen anyone in the mainstream financial media to discuss any of the reasons that you said. They all seem to be spinning it towards that Congress is going to help the electric vehicle companies and Tesla with these new electric vehicle tax credits and additional subsidies, and that's trying to they're trying to justify the stock move that way.
So I mean, Tesla guided to producing 1.8 million cars this year. They produced in Q4, I think it was 438,000 cars. My point is, the Q4 run rate annualized for this full year, they're saying they're only going to make 2 or 3% more cars than they did then. And they didn't even guide to selling 1.8 million. They just guided to producing 1.8 million. I mean, the inventory really piled up at the end of Q4, which is one of the reasons they had to put these huge price cuts in January. And by the way, they had already cut prices in many parts of the world in December, particularly China. I mean, so prices in China are like 20% lower, I think, than they had been. They now sell in China, they sell the Model 3 for around $33,000. Okay. And they sell the Model Y for around $38,500, $38,000 to $39,000. There's no way they're making money at those prices. I mean, if they are,
so they're just clearing inventory. So they're just clearing inventory then.
Well, it's not just clearing inventory. That was a big part of it, yes, but they're building new cars and selling them at those prices, and because for Musk, the whole illusion of this thing was, quote unquote, the growth story, the hyper growth. So they're just doing the age-old automotive, thing of slashing prices to move inventory. And the thing is, the sales are still disappointing in China. They finished third last week, not just behind BYD, which is just destroying them. BYD is selling what, like 3 or 4 times as many cars, but they finished behind another electric car maker. What Tesla's doing on this price slashing, it's actually terrible for all the pure play electric car makers. Because if you're going to start a price war there, they're all going to be hurting. But the funniest thing was these dopey Tesla lemmings who say, oh, they're going to destroy the legacy OEMs this way. I'm like, you dummy. The legacy OEMs get 95 or maybe 97% of their deliveries, their sales, their cars are highly profitable ICE vehicles, And so, if they have to slash prices on 3% or 5% of their volume to match Tesla, then so what? They can easily cross-subsidize that with profits from 95% of their business. Tesla doesn't have any highly profitable business anymore to cross-subsidize with. Those 12% price cuts, call it 11% because they re-raised prices by a few $100s on some things. That's straight out of gross margin and thus straight out of net profit. There's no economy of scale in producing 3% more cars this year than you produced at the Q4 run rate, which is what they got. This is what they guided to, and meanwhile, materials costs are still going up. Okay, maybe they're not as inflating as quickly as they had been, but they're not coming down in cost, and labor is not getting cheaper. Labor's getting more expensive. So, it's absurd. It's terrible for Tesla what they did. Yes, it's also probably terrible for NIO and XPeng and Fisker when he starts getting any pure play EV maker, it's bad for, but the legacy OEMs who make some terrific electric cars now, some of them better than any Tesla and more advanced than any Tesla, they've got massive profits that they can, so they can say, all right, so we'll lose, $2,000 on each EV or whatever, but we're making $15,000 on each SUV, and that's 95% of our business or whatever. So, that's why it was shocking to me the run Tesla had. But then you look at it, and it's not a fundamental run. It's somebody coming in, some group of people, supporting the stock just through massive call option buying. Look, some of it's probably quant funds. The stock got very, very, very oversold. Into the end of January, into the end of December, beginning of January. Really, the RSI and all that stuff. It was way in the red. It was way oversold. And, to the point where I sort of, at that point, had my short position, which had been very big. I was kind of leaving it in runoff, situation. Like I wasn't adding to it. I wasn't taking away from it, but, it was just declining as a percentage of AUM because the stock was down so much. And I was like, okay, this is fine. But then when they slashed prices and I realized that they would start showing negative profit comps for this year, I redoubled the position, at around $117. And then all this crazy call option buying came in. And then, of course, it slammed me. It crushed me. But I have not given up. We still have a very large position. And I think we're going to make all of that back on the way down, and then a lot more as this thing continues into, probably low double digits at some point.
In your recent newsletter, you compared Tesla Motors to Netflix, but I've also heard Doug Casey say that the pioneer in an industry also often gets shot full of arrows. So they don't end up, even though they were the first mover, they often end up not being the one that succeeds and survives long term.
Well, let's be clear about something. This is the auto industry, okay? This isn't Tesla wasn't a first mover in anything. They were a first mover in a particular drivetrain within the overall auto industry, yes. But, once all these engineers, and this is what's happening, once the engineers who can design emissions compliant internal combustion engines that can run, 7 or 8,000 RPM and last 400,000 or 500,000 miles, right? Just on an annual oil change and maybe spark plugs every 100,000 miles. I mean, if you can design that, you can design an electric drivetrain. And of course, once they turn their focus onto that, that's exactly what's happened. I mean, Hyundai and Kia, their EVs, which are priced equivalent to the Tesla Model 3 and Model Y, and the ones I'm referring to are the Hyundai Ioniq 5 and the Kia EV6, and now there's a new one coming out, the Hyundai Ioniq 6, which is a sedan. Anyway, these things are more technically advanced and sophisticated than any Tesla. They're all built on 800-volt platforms. Tesla's built on a 400-volt platform. That means they can charge faster than any Tesla. The real-world range of all these cars is pretty comparable, sometimes more than any Tesla, sometimes slightly less. You got to go with real world, not Tesla's claimed EPA numbers. Edmunds has a website where they test almost every EV for the real world. And, the longest in the real world is Lucid, and then the Mercedes EQS and the BMW iX. The point is, once these sophisticated auto engineers start applying themselves to electric cars, goodbye Tesla, especially because Musk is not spending the money on new products and R&D. Musk did what he could. He skimped every possible way, including obviously with customer service, to try to squeeze out some profits so he could say that the stock has this profit story, stock would take off. And then, of course, he dumped tens of billions of dollars of stock. And I'm sure he'd like to dump a lot more, and will do it as soon as he feels he can get away with breaking his promise not to dump anymore for a couple of years, right? I guarantee he'll break that promise. He lies pathologically. So, again, to be the first mover, they're only the first mover in a different drivetrain, right? First mover in diesel, right?
You don't think that
there's a first mover? What? Go ahead.
You don't think the Roadster was innovative at least at some point? I mean, they've deviated enormously from that. I mean, he was going to make.
Yes, it was very innovative to wire together whatever they did at that point, 7,000, similar to AA batteries. It was very innovative. I agree, but they were the first mover on that particular drivetrain. They weren't the first mover in the automotive industry. There's a lot more to the automotive industry. There's high quality manufacturing, there's distribution, there's service. These are all the things, by the way, that Tesla is miserable at. Musk sometimes admits it. He always admits it, actually. He just doesn't want to spend the money to fix it. But, so I'm just taking some issue with first mover in that sense. That's all, I mean, and nothing stays proprietary in the auto industry for more than 1 4-year development cycle. I mean, at one point, the automatic transmission was proprietary. Power windows were proprietary, and FM radio was proprietary, right? Climate control, power steering, power brakes, seat belts. These were all things that some automaker came out with before everybody else, and 4 years later, everybody had them. So in this case, it was a little more than 4 years because they wanted to see the market being proven, and plus, the government started forcing them into it. But people said, "Oh, we can do that," and they did it, and they did it better. I mean, the Mercedes EQS is a hell of a lot nicer than a Tesla Model S for roughly the same money. Go ahead.
Well, also, if they're manufacturing in China, I mean, there's no way that the Chinese are going to adhere to intellectual property and patents and things like that. So, yeah, the Chinese are going to copy everything.
Tesla has no intellectual property that's worth having. At one point, Musk said, he would open his patents to everybody. Remember, he was saying that a few years ago. I don't know if you've been around long enough. No one cared. What does he have that anybody can't replicate themselves, that anybody needs, right? So, there's nothing there. There's nothing there. I mean, his battery management software at the beginning was very good, but, other companies get the same range and longer range now. Sometimes Tesla's a little more quote unquote efficient. In other words, they can go a little further on a little bit less battery, but that's mostly because the interiors they weigh less. The interiors are just stripped out, bare bones, dangerous interiors. And when I say dangerous, I mean to have all your controls only on a center-mounted touch screen, right? Without forcing you to take your eyes off the road and figure out where to touch on the screen. That's friggin' dangerous, man. I mean, I would never buy a car like that. And of course, the other EV makers, almost all of them, yeah, they've got those screens. Many of them have multiple screens now. They look very cool, but they also at least have some buttons, right? And they'll put more buttons on the steering wheel because they know it's dangerous to do it the way Tesla does it. So, but their cars do weigh less typically, but that's the reason. They just have cheap interiors.
Yeah, I've driven in a Tesla. Actually, my friend he rented it for a weekend, and it has pretty nice acceleration, but the inside of the car I wasn't impressed with.
I mean, it's like, it makes a Yugo look luxurious, I mean, it's just, yeah. And by the way, every electric car has nice acceleration. That's what they do. They have instant torque, so they all accelerate similarly. I mean, go drive a Mustang Mach-E. It's so much nicer inside than any Tesla, right? That's got the fast, smooth torque, and of course, the Porsche Taycan, and is super fast, but that's a higher price. But I'm telling you, the cars right now, the state of the art, sort of mass market priced cars are the Hyundai Ioniq 5 and now the 6 sedan and the Kia EV6. Those are the cars that are they're the ones to own. People ask me, they say, I want to own an electric car. What can I buy for, between 45 and 55,000? It's a no-brainer. It's those two cars. In fact, they got to ramp up production because there's so much demand for them. There's a pretty good wait for those two cars.
So you think then that Tesla's a busted growth story stock then, unlike what the Tesla bulls are claiming that there's still a growth story here? It's similar to Netflix, the problems that Netflix is having.
I mean, how can you with a straight face claim this is a growth story when they just cut their per car profits in half with those massive price cuts? Okay, I mean, sure, they're gonna move more units. Although actually, I'm surprised how few or more. I mean, it looks like China may actually be down versus Q4 despite these massive price cuts, and Europe also looks as if it might be down versus Q4 despite these huge price cuts. The only place unit deliveries are going up pretty well is the U.S. Because we just got the new tax credit, which those guys don't have over there. So. But I mean, how is it a growth story if it's profitless growth? I mean, they'll sell more cars this year, but they're going to earn significantly less money in terms of profits. So how is that a growth story? I mean, these people live in fantasy land. They're not looking at facts.
It's a confirmation bias echo chamber. I mean, a lot of the Tesla bulls say that they own a Tesla, they drive a Tesla, it doesn't break down, and therefore, because their Tesla works well, they think that the company and the product is successful.
Well, again, all these people are like, oh, it's the best car I ever drove. Well, what did you have before? Well, I had a 1999 Prius, or I had a 1995 Toyota Tercel. I don't know what the hell they had. I mean, I tell them, okay, go drive one of these other 7 or 8 competing electric cars. They're not every competing electric car is quote unquote better than a Tesla, but a lot of them are nicer and better, So, I mean, or at the very least comparable with nicer interiors.
All this competition, Mark, is eventually going to destroy their profit margins even further, though, probably.
Well, right now, this year, with the big price cuts they put through, I suspect they'll go from having some of the highest claimed margins in the industry to some of the lowest margins in the industry, because as I said, they don't have the profitable ICE cars to offset these massive price cuts. But again, I mean, look, Tesla earned $4 a share roughly in 2022 GAAP, and this year they're going to earn roughly $3 a share. Could be less. Depends. So, I mean, that's not a growth story. You can't say it's a growth story if they sell, in Q4, they sold 405,000 cars, roughly, going by memory. So that's annualized. That's what, 1.64 million cars, right? If you go from 1.64 million cars annualized Q4, and this year they sell, 1.8 million cars, you're only growing in terms of roughly 11% in terms of units, but your profits are going to be down at least 25%. How is that a growth story, to just slash prices to move iron? I mean, that's what the auto industry has always done. The auto industry is selling at 6-7 times earnings, 5 times earnings. You want to buy an auto company, buy Volkswagen. Their stake in Porsche alone, last time I checked, I can't vouch for it today, was worth more than the entire rest of the company. So if you bought Volkswagen, you were basically getting paid to take, Audi, Cupra, Volkswagen itself, the trucks, everything. I mean, you got these companies are selling at, as I said, 4, 5, 6 times earnings. Okay, if Tesla sold at 6 times earnings, which it should, because it's like any other freaking car maker, and it earns $3 this year, that would be $18 a share. And then they try to say, oh, but what about, they're going to have this great battery business. The battery business is worse than the car business in terms of margins. It's a lower margin business than cars. It's a terrible business. So, and by the way, they don't even really make they're trying to make some of these 4680 batteries, which are really no improvement over any other battery. They're just bigger. Originally, they were going to have all this proprietary chemistry in this, and as it turns out, there's nothing special about them. They're just sized differently, and they're having trouble making them. But okay, so they're making some. Whatever they're making, it's a crap business, So, and they still need batteries from other suppliers. So, yes, there will be some incentives like $3,900 for each car battery they make, but they're not really making them. They're barely making any. It's not enough to make a difference, and that's only in the U.S., right? The U.S. is only, I don't know, maybe 40% of their worldwide sales, something like that. So originally Musk said it would only be a third, but it's a higher percentage than that. So yeah, and then of course, on top of that, the guy being such a schmuck has destroyed his brand. So there's a lot of people who just now won't buy a Tesla under any circumstances, So and he also destroys the brand with the massive price slashing. I mean, BMW would never do that. You buy a BMW and you're like, prices only go up every year on these things, and I can get my money back. I mean, I had a 2013 Porsche Boxster S, and I kept it for 10 years. It's just a weekend toy for me. I had 30,000 miles on it because I don't need a car. I live and work from home in the city, in New York City here. And so I paid for that car. I think I paid maybe $68,000 or something like that. And after 10 years, I sold it for $45,000, right? I mean, it because it's a Porsche, and every year they raise the price, and now the new equivalent of that car is like $110,000 or whatever, right? So so the old one kept its value. If Tesla just slashes its prices the way it did, you're all of a sudden you're underwater on your Tesla now because you bought it and it's 15% cheaper the next day,
And electric vehicle cars don't tend to not last as long as the well-made internal combustion cars. I mean, there's so many extra parts that need to be replaced faster.
Well, no. Well, there are many more parts in an internal combustion engine than there are in an electric drivetrain, but the internal combustion engine has been so well developed over the last 120 years or whatever it is that, I mean, talk to a New York City cab driver or an Uber driver or whatever who's got a car with 350,000 miles on it, and all he's had to replace or sometimes some of the suspension pieces, which is the same thing you'd have to change on a Tesla just because they get they get beat up. So they're, ICE vehicles are very reliable, and the maintenance is, a tiny fraction of what it used to be. I mean, you used to have to do all this stuff, right? Now it's an annual oil change and, maybe spark plugs at 75,000 miles or whatever, and other maintenance is universal for cars, suspension stuff or tires. In fact, electric cars use up tires faster than ICE cars because they're heavier, and that's a whole nother issue. So the issue on how long an electric car lasts is decline in the battery capacity. And the jury's still out a little bit on that. For one thing, there are a few ultra high mileage Teslas out there, and you've seen them, you can find articles about them. They've all had the battery pack replaced multiple times, right? I don't know what the longest, what the longest original battery pack is, but, my guess is that if you took a Tesla battery and you got 250,000 miles out of it, you'd probably lose 30% of the capacity by then, something like that, right? And that's not going to happen on an ICE car. And then, when you rebuild or replace your ICE engine, at if you have to do it at 300,000 or 400,000 miles, it typically costs you $3,000 or $4,000, right? And sometimes you can put a used one in for a lot less than that. Whereas the Tesla battery pack is probably something like $15,000, give or take. So it's almost as if they're disposable. I mean, they're talking now about taking these used battery packs and turning them into like electrical storage, or something like that, which, yeah, I mean, it's better than nothing. But the fact is that, these cars are not as environmentally friendly as people like to pretend they are if they become disposable, right? I mean, by far the most logical thing to do with cars environmentally are the light hybrids. Like there's a new Accord hybrid, there's a Camry hybrid, there's the new Prius, which is much faster and better looking than the old Prius. These cars all get around 50 miles per gallon. Prius gets a little more, and they all cost around $12,000 to $15,000 less than the equivalent full battery car, and they are far less energy intensive to manufacture than a battery pack, and so they are much better over their lifetime environmentally, or at least somewhat better over a long lifetime because they're getting 50 miles per gallon, and they're less intensive to make, and they're cheaper. I mean, you could take that $12,000 or $15,000 difference and plant 15,000 trees if you want, right? Or you can give it to Greenpeace or whatever. So there's just an idiocracy going on among politicians worldwide for jamming full BEVs down people's throats when they should be doing these light hybrids. I mean, for the amount of battery material in one BEV, you can build like 70 light hybrids. I mean, it's some crazy amount, So it's just stupidity. But politicians are not known for being bright, and you got shysters like Musk who have convinced them that this is what they should be doing, and so here we are.
Well, I mean, there's trillions in ESG spending. I think it's not just Musk. I mean, it's global, and there's tons of grift going on from a lot of these different companies. I live right outside of Washington, D.C. I mean, it's all they talk about. There's tons of family and friends that are involved in these green energy companies. I mean, I've met the kids, the adult children of ESG lobbyists around here and green energy and electric vehicle lobbyists around here. And the kids are driving $150,000 gas guzzling Range Rovers that have nothing to do with a hybrid or electric vehicle, while their parents are doing all the lobbying for more ESG spending and stuff and subsidies and tax credits.
Right. Yeah, I agree. I mean, the whole thing is an absurd disgrace, and politicians are disgraceful for not doing any kind of homework and doing cost benefit analyses on these things. But that said, there are some, green energy things that give you a better bang for the buck than others. And among the smallest, the least amount of environmental bang for the buck, so to speak, is BEVs, fully electric cars. I mean, in terms of in terms of what they do for CO2 emissions versus full life cycle versus a 50 mile per gallon light hybrid. That's why when you see these comparison charts, right? They set up what we used to call in college a straw man argument. Something that could be a phony thing that you could blow over with a breath of air, and that they'll say, well, let's compare it to this 25 mile per gallon car, and it's much more efficient over the lifetime. But that's bullshit, because if you're going out to buy a new car, you got a choice. Choice A is, a new Tesla Model 3 or Model Y, and choice B is a new 50 mile per gallon, light hybrid, like a Honda Accord hybrid, which, by the way, these cars all go 0 to 60 now in like the 6s or maybe the low 7s. I mean, they're more than quick enough for the vast majority of people. They're not slugs anymore. They all have over 200 effective horsepower. So, they set up these phony comparisons in order to try to make the BEV look better,
Yeah, and if they really cared about the environment more, I mean, they would focus on more efficient electricity generation. Nuclear power is just not getting any. It's not
right.
getting any of the credit. I mean, that's because look at Germany and a lot of these other countries. They switched over the winter. They switched to coal. Natural gas prices for liquefied natural gas in a lot of different countries are 10x the price of here in the U.S. So I mean, the
total
electricity.
Idiots.
Well, the electricity. So yeah, you can have an electric vehicle, but you're still plugging into the grid. You're going to overload the grid, and then the electricity, a lot of it's being generated from coal.
Well, that's another issue. Yes, for sure. But even on the assumption that you'd get most of the electricity, from nuclear or windmills or whatever, they're still nowhere near as efficient for the full life cycle, including the ugly, messy business of mining the minerals for that battery, as people think they are, versus a light hybrid. So, and if you look at like the bang for the buck on CO2 emissions, like large freight ships put out a massive amount of CO2 and also air pollution, considering like, where they are in terms of the world. I mean, there's hundreds of millions of cars, right? But they don't, some of, the like large freight ships put out just tons. Cement manufacturing. I mean, this is stuff, Bill Gates talks about this sometimes. I mean, he's aware of it. And in fact, I think he's working on trying to come up with cleaner cement manufacturing. There are just, they go for the low hanging fruit. Oh, look, you can see the electric car in the driveway. But that's not what they should be subsidizing. Or if they are, they should be subsidizing a light hybrid where you can get 70 of them or whatever the number is for the same battery material. But politicians are just fucking idiots. I mean, if they were smart, they probably wouldn't be politicians. They'd have a real job. So
they're corrupt. I mean, if you're in Congress, you're making $175,000 a year, and then that doesn't even count any of the side deals that you're doing for millions of dollars. So your net worth can go to $10 million pretty quick.
Well, I don't doubt that some of them are corrupt. Some of them are just scummy with the stock trading. I mean, Pelosi's the most classic example of that, but a lot of them do it, right? I mean, trading stocks on companies they're regulating or whatever. I mean, that's a form of corruption, even though it's disgustingly legal, apparently. But some of them are just stupid. Most of them are just stupid. And they're like, oh, we're going to save the world with this. I mean, they're dumb. If they were smart, they wouldn't be politicians. They'd be doing something else. So anyway, it is what it is. I mean, I'm not going to be able to fix it. So I try to get zen with it, even though it does piss me off when I think about it,
So Mark, in your newsletter, you talk about how you're the most bearish on the S&P 500 rather than on Tesla. Is this related to the Fed raising interest rates, still keeping them higher, inflation, the global macro situation? Why are you the most bearish on the S&P 500?
Well, to be clear, Tesla's going, in my opinion, Tesla is going down a lot more than the S&P 500. But my S&P 500 short position is bigger than my Tesla short position, even though my Tesla short position is very big. But the S&P one is even, let's say much, much bigger, very bigger, just because it's less volatile. I mean, it's just like, it's S&P is not going to go up or down 10% in a day. Well, I don't care if a short position goes down 10% in a day, but I care if it goes up 10% in a day. So look, I mean, I think I write this in my letter, and so I'll sort of paraphrase myself here because I don't know exactly what I wrote. But, look, we had probably the biggest asset bubble in history, and not just stocks, but, negative yielding bonds, NFTs, cryptocurrencies, which, by the way, Bitcoin got a second life in the last 2 weeks. It's amazing. But anyway, all this crap, because we had like over a decade of ZERP, a decade of money being free, and on and off QE, quantitative easing, among every big central bank in the world to the tune of hundreds of billions of dollars a month when you added it up among all the banks, right? And so we built this massive, incredible bubble of everything. So if all of a sudden now you've got interest rates at 5% or close to it, high fours going to over 5, and you've got 90 billion a month of QT, quantitative tightening in this country, and the ECB is going to be doing QT. There's no way that giant bubble can pop. I mean, everything that built it is being reversed to the max, right? Now, one thing you may have read and I've read is that one of the possible explanations for how stocks had the liquidity, how people had the money to drive stocks up the last 6 weeks, January into the first half of February, is because of the debt ceiling issue. And so the Treasury was basically had to spend down its savings because it couldn't issue as much debt as it normally would. And that's a possible explanation, for where some of this money came from, despite the Fed doing its QT. And then, of course, Japan also did even like extra QE to try to preserve the yield curve control there. But I think they're going to have to give that up. I mean, they've got real inflation in Japan now. You can't just keep capping the 10-year wherever it is. I don't know where they have it capped now. 30 basis points, whatever, something stupidly low. So I think they might have to give that up. And of course, the ECB is going to start reducing its balance sheet at some point not too far away. So you put all that together, this was like a temporary blip of liquidity. I think it declines in Japan. Clearly, they'll make a deal on the debt ceiling, and then Treasury will start, selling debt again, and then the ECB. So, it's this weird window of liquidity that in a very oversold market that allowed us to have this big rally. But once they start, once they start saying that they're close on a debt ceiling, deal, which they will. The market's going to front run whatever Janet at that point is still, spending out of her savings, so to speak, out of the Treasury savings. And so you don't actually have to wait for the deal to be signed. It'll, the same way QE got front run, So, I think this market, I mean, I've been saying it for the last 2 weeks or maybe last 10 days that it was imminent, that I've been calling it a wild coyote market, a market that's blithely went off a cliff and is hanging in midair and just doesn't know it. And I've been saying it, every day for as I said, the last week or so. And maybe it happened today. Maybe this was it. I mean, look at the data we got this week. We got a hot CPI. We got hot retail sales. We got a hot PPI. We got very low unemployment new claims today. I mean, you got a bunch of Fed people saying we're going to be higher for longer, and saying it again and again. It seems to me that that all the elements are there for this market to recrash. And of course, sentiment swung all the way into just total cockiness. I mean, I get the I'm very active on Twitter, as you probably know, and when the Teslemmings just come at me and mock me all day long, you're a moron. You reshorted Tesla at 117 and blah blah blah, and that just hit like peak this week. I mean, I get sometimes I get emails from Teslemmings. I just instantly block them. I don't even read them, and they just goes right into the spam file. So, but that always tends to happen near a top for Tesla, and a top for Tesla is often also a top for the NASDAQ and the market overall. So, we'll see. I'm very, very short. I've got steadily shorter. I shorted a lot more of the S&P even after the close, when it was trading up after the close last night. And we'll see. I'm still getting slammed this year, but I wouldn't be surprised if we made it all back in the next 3 weeks.
That'd be a lot of volatility then within a 6 to 8 week span, where we had this incredible rally the last couple weeks and then it goes right back down. That would be like a roller coaster.
It sure would. But that's what happens in bear markets, And once this bear market once things bottom out, I mean, I've written about this also on Twitter. I mean, I've got a much lower target than a lot of other people out there. I mean, if you look at GAAP earnings for the quarter that's just getting reported, Q4, and you annualize them, and you put a 16 multiple on them, which is pretty freaking reasonable for a 5% rate declining earnings market, environment which we're in, that puts the S&P like in the 2600s. I mean, right now as I'm speaking to you, it closed today at just under 4100. Right, it closed at 4090. I mean, I think there's a long way to go. And by the way, in a typical bear market, from peak to trough, I mean, in 2000, I think the S&P fell 50% or so. In the 2008, one, I think it fell around 50%. I mean, if this one fell 50%, it would be, pretty deeply into the 2000s. So, right now, like the biggest bears, I mean, other than the outliers like me, and then the really heavy duty outliers like whatever, John Hussman or whatever his name, those guys. But I mean, they were like, oh yeah, I'm really bearish. The S&P is going to 3,500. Well, what if it goes to 2,600 or 2,700? That's still a pretty good multiple on what earnings look like,
Well, we're seeing a lot of signs in the real economy that inflation is still bad, and that the recession, the government doesn't want to talk about it being a recession, or the Wall Street banks don't want to talk about being a recession, but there's tons of examples of it being a recession. I mean, there's mass firings at big tech, a lot of S&P 500 companies. I have a lot of friends in finance that were earning that had six-figure jobs, and they just lost their jobs and they're looking for new jobs. And it's all like textbook recession. Or you were an investment banker, so it's all textbook recession, but the government doesn't want to say it's a recession. So I think at some point, if this continues with the firings and the inflation.
Right. Well, it's not a recession yet, but all the indicators are spell red, red for recession coming, right? And like the yield curve inversion, the plunge in like ISM new orders, the S&P earnings yield versus short-term treasury rates. I mean, all these things add up to a stock market that will plunge, right? I mean, so yeah, I mean, there's a lot of fundamental data saying that this market is going to go a lot lower. I mean, one issue is, you've had this sort of relentless dip buying during this rally because, people have been trained. They're like trained seals. They're trained monkeys for 15 years or 14 years of ZERP and the Fed having your back and everything else. And you buy the dip. And for all these years, everyone would just say, "Hey, Tina, there is no alternative." Well, guess what? When interest rates were zero, it was Tina. But you can now get 5% on a 6-month Treasury bill, man. that's about as opposite of Tina as you can get when S&P earnings are declining and stocks are selling at a high multiple of them, you know? So, I mean, cash is a hell of a good alternative to stocks right now. You know, it's an alternative. So, I've been talking about this too this week on Twitter. It's, you know, you're just going to see people say, you know, screw it. What do I need this for when I can just get 5% in cash for 6 months and reassess then, you know?
So as we wrap things up, I've been asking all my guests this, is there anything you're actually optimistic about? Any companies, any sectors, anything in the economy that you're actually optimistic about? Or do you think there's a lot more pain in the near future?
Well, I mean, you know, as they say, there's always a bull market somewhere, you know. We're long some of these traditional auto OEMs just because they're so cheap, but they'll probably go down with the market if the whole market tanks the way I'm talking about. But, you know, they'll go down less, I think, you know. I mean, I'm sure there's, you know, if you want to ride the subsidy game, there's probably some of these quote unquote green stocks, maybe which aren't too expensive, which maybe can make some money going forward. I mean, I don't have any names for you. It's definitely not Tesla, which is selling at 70 times what it's going to earn this year with declining earnings, you know. But, you know, there may be stuff there, but overall, it's going to be a hard, I mean, maybe oil. I mean, you know, we clearly don't have enough oil, right? And you know, we're going to need it for a long time. So there's a play there. Maybe natural gas is a play. I mean, natural gas has just had the shit kicked out of it. I'm looking at it now. It's you know, in the high 230s, right? And you know, that'll probably bounce at some point, you know. But so I would say, you know, somewhere in the commodity sector is probably the best hope for stuff that's going to go up over the next year. But other than that, you know, if you don't short stocks, and by the way, the vast majority of people should not short stocks. I mean, it's just somehow I have the mentality for it. You know, I mean, look, I rode Tesla up like 20x and never quit. And then last year we were up huge because it finally tanked, right? But you have to be a rare kind of, you know, sociopath. That's not the right word because I'm not a sociopath, but you got to be really like, you know, clinically unemotional and just know you're right and just say, you know, I know I'm right and I'm not going to let this bother me. And so most people should not short stocks, but cash is a pretty damn good alternative if you can get 5% a year on a 6-month treasury bill. So, you know, you may want to think of that. And then of course the tricky part is when to get back into the market, and that's hard because over time, for sure, I mean, over decades, the market goes up. I mean, at least in nominal terms, it goes up just from inflation, but you know, in real terms also. But you could also have long stretches of, you know, 15 or 20 years we've had occasionally when it does nothing. In either real or nominal terms, sometimes it doesn't go up, you know. So and that tends to happen after in the aftermath of a massive bubble. So you know, it's tough, but I would say wait for stocks to get a lot cheaper before you go back in, and don't worry about catching the bottom. You'll never catch the exact bottom, and maybe they'll go down another 15% or whatever, but you know, eventually they come back if you have a long enough time frame. I mean, it's a different situation maybe if you're 65 or 70 and about to retire, then it's harder, you know. Then you don't have the luxury of 20 or 30 years, you know, before they all come roaring back.
Do you think we're going to have record volatility in the next couple of years because of all the different policy changes that these central banks are trying to implement so quickly?
Well, I don't think it's going to be. First of all, I don't know how you define record volatility. But I don't think it's going to last that long. I mean, I guess what I'm saying is my best guess, which is worth what I'm charging for it, which is zero, is, you know, this market starts retanking, and then over the next year and a half, something like that, it reaches a bottom, which, as I said, I think it's going to be somewhere with a 2 handle on the S&P 500. And then it could just, and that'll be the volatility that tripped down. And then it could just do nothing for a number of years. I mean, it could literally just be like, dead, and people lose interest in stocks. I mean, that's happened a number of times before. And, people leave Wall Street and they go to other professions, like the way when the housing market dies, all those new housing brokers wind up going back to their old jobs or whatever. And so I think you're going to have a lot of years of boredom after this market bottoms out. I don't think it just comes roaring back so fast, but I could be wrong about that. And I might change my mind about that, at any time, depending on what's going on and how much they go down,
Well, I think, Mark, we're looking at a government debt crisis, a global one, because you talked about Japan. I think Japan can't afford 2 or 3% interest rates. I mean, they have that much debt, that much problems with their government debt. So their pension funds, Japanese savers, they can't buy the Japanese banks, which are zombies for the last 30 years. They can't go and buy more Japanese government debt. So they can't afford more government rates. So basically, they've trapped themselves to where either their currency has a problem or the central bank has to keep buying the government bonds because they can't afford the higher rates. So they're in, like, I guess, a Minsky moment type of crisis.
Well, yes, at some point that's going to be 100% correct. But, you say Minsky moment. A moment implies like now. And, we don't know when that moment will be. Yes, it'll happen, but I mean, these things can sometimes take decades. I mean, I'm shocked Japan has had as long as it's had, right? How it's been doing this for what, like 30 years or something like that. But, as long as people have faith in the yen, they can get away with this crap, right? And, people might have faith in the yen for another 30 years, right, before it happens. It's, for years and years, people called that trade, shorting the JGBs. They called it the Widowmaker because it was obvious that it's going to happen at some point. But it's also impossible to time it. I mean, basically, if you happen to be, and assuming there's some cost to carry. I mean, if there's no carry cost, you can just put it on and forget about it. But of course, there's a carry cost. And so, if you happen to be the guy who's short it when the Minsky moment happens, well, yes, you were absolutely fundamentally right, but you also got really lucky with your timing because there were a bunch of guys before you just as smart, and just as fundamentally right, and it just took decades longer than they'd think, right? So I don't know when it's going to happen with Japan. And of course, it'll probably happen here too, but maybe it happens here in 75 years. It's very hard to game this stuff, right? I mean, it should have happened with Italy during the financial crisis, right? And Spain, and the ECB, bailed them out, So, but, eventually it's going to be who's going to bail out the ECB, right? I mean, look, that's why I have a modest sized gold position, right? Because eventually, gold is going to fly. But meanwhile, gold is probably going to tank with stocks, just not as much. I think stocks are going to tank big over the next year to 18 months, and gold will also go down, just not as much as stocks. But soon before it tanks, before stocks bottom out, you'd probably want to load up on gold. And I assume you'll be able to do it at significantly lower prices than today, because all our central banks know how to do to get us out of a nasty recession is print money, right? And eventually they're just going to print too much money and blah, blah, blah.
Asset bubbles. Yeah. Well, the main thing is, especially here in the US, was inflating the asset bubbles. But I guess they can try to destroy the currency for one last bubble, but I think they're running out of bubbles to inflate.
Well, yes. I mean, I'll say yes and no. We don't know. I mean, logically, the housing bubble should have been the last one. And then look what we got here, right? So who knows how many more of these they can do? I don't know. I mean, nobody knows, really. I mean, any smart guy who looks at this says, yes, it's inevitable that they do one bubble too many. But also any smart guy who looks at it says, but I don't know how many is one too many. And it's just the way it is. It's not necessarily actionable, you know?
And that's why people buy gold as an insurance policy. Also, Mark, I think,
yeah.
Also, I think with these rate hikes, I mean, I don't think the Fed's going to immediately start slashing interest rates, at least not yet, not unless we get like a large bank failure, a couple of them or something like that. But if the Fed keeps the rates even at these levels, I mean, we're going to see a lot of bankruptcies from a lot of companies in a lot of different sectors.
I agree 100%. I mean, that's the whole higher for longer thing, you know? I mean, yeah, I agree. I mean, there's all kinds of debt out there, you know, companies with debt, individuals with debt that was not designed for 5% interest rates, you know, and if they get inflation down to 3.5 to 4 consistently, you know, so let's say it's real rates of 1.5 short term, and so, you know, lending rates are going to be higher than those short term Fed rates. I mean, you know, I just looked at car loans, and it's like 6.5% for a car loan now, right? It was 1.9% when a lot of people bought their last car. It was 1% when, you know, and so yeah, people are not equipped for this. Companies are not equipped for this, and yeah, this is part of why I think we're going to have a really nasty stock market over the next year to 18 months. Albeit with some stupid ass rallies like the one we just had, you know?
Yeah, we already have a subprime auto loan bubble bursting. I mean, like anyone who needs a car loan and doesn't have a good credit score, I mean, the borrowing costs are enormous now, how much they've spiked.
Yeah, well, right. That I'm seeing in like, what, 10, 11%, or, you know, some crazy prices. Yeah. And you know, some people are underwater on their cars too, as used car prices started plunging. But that said, they actually bounced back somewhat last month, which surprised a lot of people. So it's clear, you know, just to go back to what I said a little while ago, you know, this is a world of assets built on a decade of ZERP and a decade of QE. And now we've got the opposite of that almost to the extreme. It just would defy common sense to think that these assets built on the former could survive the latter.
Yeah, I agree. Unless the Fed, the U.S. government, Congress, the Fed, the U.S. Treasury, other central banks, they coordinate and change the rules, because that's what has happened behind the scenes.
Well,
I mean,
then you want to own gold.
Yeah, and you talked about Italy, why you're surprised. I mean, behind the scenes, we've seen from New York Fed disclosures, from Dodd-Frank, I mean, the Federal Reserve Bank was giving the European Central Bank trillions in currency swaps that the European Central Bank doesn't have to pay back. That's how these things have slugged along for so long, why there wasn't failures.
I don't know if that's true, that they don't have to pay it back. I don't know. I don't know enough about it. I heard that you said that. I'm not saying you're wrong, but I just want to make it clear that I'm not necessarily accepting that at face value. I'm not sure. You know, I don't know. But it doesn't, I mean, we're saying the same thing. And so, and again, that's why you want to have some gold. And, you know, even though, I mean, I'm comfortable having gold now because I'm short so much in terms of stocks that if the gold goes down, I think the stocks will go down a lot more. I have a good friend who's a real gold nut or gold bug, and he keeps, you know, jamming into my brain the fact that like the gold to, you know, the gold index or whatever to S&P 500 ratio is like at record lows. I mean, he keeps looking at this thing, and so I assume there's something to what he's saying. And so I think that's why they may both go down, but stocks are going to go down a lot more than gold. So, you know, I think if you're long some gold and short stocks, I think net you'll do fine over the next year and a half. But that said, I'm advising the vast majority of people not to short stocks. So just realize that cash is a perfectly legitimate asset class, is how I would tell the vast majority of people. Don't get involved with shorting stuff, but cash paying what it pays now is a perfectly fine asset class.
Well, Mark, I've kept you for over an hour. I really enjoyed our discussion today. We covered a lot of interesting topics. If my listeners want to follow you on Twitter or take a look at your newsletter, how do they do so?
Well, the newsletter is just for, it's sort of a certain group of people. But you can certainly follow me on Twitter. I tweet under the name of my fund. It's at Stanphyl Cap, and Stanphyl is spelled Stanphyl. The letter Y is in Yankee. Stanphyl, Stanphyl Cap, CAP. So I'm pretty active there. It's probably a third Tesla, a third other finance stuff in general, and a third just like off-color jokes, just riffing off of headlines that I see. The kind of politically incorrect jokes that no one else will make anymore because they all have a boss and I don't, so I don't give a shit. I just say what I think is funny. So that probably describes my Twitter feed.
That used to be called comedy.
Exactly. It used to be called comedy. That's exactly right. And there's nobody who's going to cancel me. So I have like a nice monopoly on stuff that a lot of other people used to say and now they're afraid to say, jokingly. So thanks very much. I really enjoyed the discussion. I hope your listeners got something out of it.